Hi there, my name's Sam. I'm a financial advisor and director at Wise. I'm joined by Dr. Steve from our investment committee. Today we're here to talk to you about evidence-based investing. Steve, there's a lot of evidence, I suppose, throughout the history of investment. Are there certain factors that perhaps have more common results or show a bit more of a consistent theme through history?
When people talk about evidence-based investing, they are referring to the scientific work that's been done, trying to sort of unravel what is it that drives returns in stock markets, as opposed to sort of randomly picking stocks and hoping they do well. So over nearly 80 years now, there's been a lot of, and continuing academic insights into what these drivers are.
What are those factors, Steve?
Yeah, so there are really three main factors, Sam. And the first one, and this is not going to surprise anyone, is that equities do better than cash over time. The second one, over time, small companies tend to do better than large companies. And the third one is around value stocks or low relative price stocks, and you can measure value by price to book or price to earnings. So a low relative price stock, called a value stock, tends to do better than a growth stock over time.
And I suppose, do you have perhaps an illustration of that for us that we can sort of show the audience?
Yeah, so why don't we look then at the evidence. It's called evidence-based investing. So what is the evidence for this? The first chart I'm putting up, I'm showing the Australian equity market just against holding cash or bank bills in this case. And no surprise, over time, there's what's called an equity premium. That's why people invest in the stock market, to do better than just holding cash. But I think everyone knows that you don't earn that premium year in, year out. So Sam, when we talk about these factors, it's a very similar story. So the chart here shows how Australian small caps have gone against Australian large caps. So the blue columns going up are when small caps do better, and the red columns going down is when large caps do better. And then the third one, Sam, again, very similar. It's about these value stocks or these low relative price stocks. And again, blue bars going up is when value has done better. Red bars going down is when growth stocks have done better. On average, you can see that the value stocks have done better.
Steve, why are these factors important then for investors?
Yes, so what we can see, Sam, is that if you tilt portfolios towards these factors, you tend to do better than if you were just in a straight vanilla index fund, which would just give you the return of the market. The evidence with factors says that, look, over time, you can do better than an index by tilting your portfolio. So that's why they're a good thing.
These factors are really important for us in the investment building process, looking at the investment philosophy and how to incorporate those in a portfolio itself. We do that at AdviseWise with our clients, and I think that pretty much wraps it up for today, Steve. Thanks for watching, and if you have any comments, feel free to shoot them below.